Of earnings reports. Here to share where he's finding opportunity in this current market environment is Chris Hyzy of Merrill and Bank of America Private Bank. Chris, good to see you.
Great as always to be with you, Mike.
You know, how are you seeing the, I guess, the big picture action? You could have said coming into this week, markets maybe getting a little bit oversold. We're at a better seasonal period. We're near some kind of potential support levels. Maybe the yields can calm down a little bit and make way for something good seasonally as we focus on earnings. Does that make sense? Are you persuaded by the action today at all?
You know, I'm not traditionally this stark as it relates to what this week actually means, but this is a big week. The Magnificent Seven, the narrow leadership, has been the news headline for a while. That passed the baton over to the 5% yield on the 10-year Treasury, and then bouncing off of 4,200 on the S&P. And there's so many cross currents, not to mention the significant rise in geopolitical volatility and risk overall. So this mountain of earnings this week, particularly in the tech sector, that has to drive some momentum and a little bit of tailwinds and some catalysts to get some of that, I wouldn't call it risk on, but to get some of that move back into the equity markets to establish these long positions again to set ourselves up for next year. So this is a big week.
What are we being set up for into next year, I guess, is also the question. It seems as if, we're a year after there was a near unanimous consensus that there was a recession coming within a year. We didn't get it, but it still feels like kind of rolling our anxiety forward every few months that, in fact, finally there's going to be some kind of an economic payback period. What's your assumption at this point?
Well, certainly the assumption is that it's a mixed bag. There's going to continue to be cross currents. The great debate, we wrote this report not too long ago, talks about, is it soft landing or is it any kind of landing? And for what it's worth, I think if you talk to businesses, if you see what's going on, generally speaking, in the forward-looking projections, what gives us some comfort is the fact that, albeit there's slower spending at the consumer level, and there's a little bit of relaxation of growth overall, we're not in that mode where we're falling down the cliff yet. The Fed hikes that we've already seen are beginning to bite, but there's tremendous resiliency out there. So what gives us comfort, Mike, is the fact that profits could actually reaccelerate next year. Now, the question still is out. Did we actually bottom in earnings? Some think we have. I think it's still a little bit of a mixed bag. But overall, when you look at next year, it should be that platform year again, more normal yield curve, more normal economic activity, and the thinking cap that goes on investors' heads should be more about the latter part of 24, 25, and 26 to establish that long-term sustainable bull market again.
Yeah, I mean, it's a good ways to look ahead, although we'll see if people can maybe use that as a frame. Now, where within the market seems like it makes sense to try and position as we head into something like that?
Yeah, I think if you look at market internals, we all know that you talk about the 493 other stocks and how attractively valued many of them are. And even when you take a look at the cyclicals, how attractively valued they are. And dare we even talk about small caps on a relative and absolute basis, and emerging markets. There's so many ands. But thinking forward, when you think about what drives long-term sustainable bull markets, eventually you got to look through the storm. The wall of worry is high. When you get that blue sky, it's almost too late. So you stick through it. You be diversified. You stay high quality right now. But overall, it's productivity. It's a resumption of the profit cycle. And it's ultimately falling yields, not collapsing yields, but falling yields, which helps support that better attractive foundation in stocks relative to fixed income. We'll touch on fixed income very quickly. A more normal yield curve is on its way. There's some pain on the way, and it's probably pain that's been extended longer than most people expected. But where real yields are right now, fixed income is also attractive.
And you're not concerned necessarily that when you do get the yield curve return to a more normal shape, everyone says, well, that's another building block of the eventual recession?
Well, not if you're coming off of the severe tightness of overall policy and you're starting to come down. And if there's more normal monetary policy where rates come down a little bit on the front end after the back end starts to look through and see slower growth, then you get a more normal yield curve, something like 3.5% Fed funds, 4.5 to 5% 10-year Treasury. That's the 1990s.